This is my 34th year at CNBC, and one of the things we try to do is financial education and literacy. And one of the things that's very well known is market timing really doesn't work. For most people, it doesn't work. And long-term buy and hold and understand what your strategy is, have a strategy, stick to it, don't change it around, because that's when you make mistakes. Everyone knows this, and yet it's very hard to get this through to the public. How do you do this?
The key to that is exactly what was just mentioned. Let the advisor be the financial quarterback for the overall portfolio, and they can decide what percentage is active, what percentage is passive. I think that's really important. It's rare to see an advisor today who's exclusively passive or active. They use both, and I think that's the important part.
At the same time, though, we have seen an uptick with retail trading, usage of ETFs, and so, at Nasdaq, as you said, financial education is a big part of it. We put out different pieces of white papers and content, so, retail investors know how to trade ETFs, know the differences between active and passive ETFs.
Oh. So I want to get to this debate about active versus passive, because it was sort of came up last week here. There was a very, maybe you've heard about this, folks, there was a very well-known hedge fund manager who complained that the markets were broken and that part of the problem was too much investing in passive funds. So this astonished me. Here is a man very famous who made a lot of money, essentially saying, I'm not making enough money anymore. So let me just ask you, are the markets broken, or are hedge fund managers frustrated that they just don't make as much money as they used to? Are the markets broken, or are hedge fund managers broken at this point?
Well, when you look at last year's returns, it's easy to see which one is broken, right? The market clears. The market's working better than it ever has. You have a tremendous amount of liquidity being pushed through. If you got left behind by market returns last year, then of course you have to say it's something broken. You're not going to look in the mirror, right? For a systematic active manager focusing on those premiums, though, more money going into passive strategies is a great thing for us. That's just more opportunity you have to be able to implement a flexible approach that adds value over time. So that's a tremendous benefit for not only Dimensional, but also our investors.
I think the problem is systematic active investing, which is what you sort of do, versus old-fashioned stock picking, which, and let's face it, it's been tough to do that recently. Maybe it's because the market just gets more and more efficient all the time. I don't know what the reason is. I don't have a lot of sympathy for hedge fund managers who want to complain they're not making enough money, but you've been doing this a long time.
Yeah, look, we actually manage systematic strategies through Parametric as well, so we're very familiar. It's active, but it's systematic. The one thing I would say, though, back to the opening, what are the trends? Active, certainly the acquisition of bonds, fixed income ETFs. The third thing is income. People have fallen in love with a 5% yield. We launched a floating rate ETF just last week. This will target a yield between 9 and 10%, Bob. And that's really meeting a need of our customer. We've been doing floating rate management for over 35 years. We manage over 30 billion. We're actually simply adding choice in an ETF wrapper alongside mutual funds and separately managed accounts. So again, this game to us is about choice. Go where you have a strength. Our strength tends to be in active management. Doesn't mean there's not great passive ETFs out there. There are for portfolio construction. We just want to make sure we're part of that discussion.
Yeah, and so just go back to you, because you're sort of like the guy who always talks about passive versus active.
Yeah.
Is there a place in your investment portfolio for active management? If I'm an old-fashioned Bogle guy and I like my index funds, is there a place that I should consider for active management of some kind? Your point seems to be yes, but systematic active management, which you distinguish from old-fashioned, let's just pick stocks.
Yes, I think it's the best of both worlds, right? You've got the diversification, the low cost of indexing. You've got the ability to outperform like traditional stock picking active management. It seems like the right solution. And we're also seeing a tremendous amount of assets flow into those types of strategies. We know that investors are interested in that balance between the two. So you don't have to pick between one and the other. You can have both.